Heya Cryptozens, tonight's show. Sam Bankman-Fried sees Voyager deal as a $70 million loss. CFTC and SEC propose rule changes. Hotbit freezes customer assets. It's 10 p.m. Pacific time. The date is August 10th, 2022. Welcome back to the Crypto Overnighter. My name is Nikodemus, and I'll be your host. The cover model, mascot, and co-host for this podcast is Tex. And together we take a nightly look at the crypto, NFT, and metaverse space and the industry that surrounds it. And keep in mind, nothing in this show should ever be considered financial advice. Sam Bankman-Fried would happily admit that not all of the deals that his companies have been making recently are winners. In fact, he would admit that some of those deals, some of those bailout deals are just kind of meh. He'd also tell you that's not the point. He'd say it's not all about making an amazing deal. Sometimes an okay deal is good enough. He also said the key is to avoid throwing good money after bad. He said, quote, "We came into this knowing that these were not necessarily going to be winners for us. We're comfortable with that fact. And I think when you look at Voyager, we'll see what happens. But best guess is like that's $70 million down the drain that we probably won't see again." Now, just as a quick recap, Voyager filed for bankruptcy in early July. This was after issuing a default notice to Three Arrows Capital. Voyager's stock dropped, and they found themselves delisted. And then it was announced that Alameda Research offered a $500 million line of credit, an offer that Voyager accepted. So far, Voyager has used $70 million of that credit line. That explains the $70 million line from the down the drain comment. That's the amount that SBF is claiming is basically lost. He said, quote, "The way we structured it was basically there's $70 million that we knew we would maybe never see again. We're not feeling too confident about getting that back." Not helping matters was the fact that a few weeks into the proceedings, FTX proposed a rescue deal. Voyager rebuffed FTX's bid sharply, calling it a, quote, "lowball bid dressed up as a white knight rescue." Now, what's interesting about all of this is that Alameda owes Voyager money. Financial documents surfaced from Voyager. These documents indicate deep ties between Alameda Research and Voyager Digital. It appears that Alameda was one of the many borrowers from Voyager. Apparently, they were into them for around $370 million. Then, after Three Arrows Capital fell, their roles reversed, and Alameda went from borrower to lender. Legal documents point toward a relationship between the companies that stretches back at least till September of last year. Now, here's what we know. Alameda Research is based in the British Virgin Islands. In the paperwork documenting the $1.6 million loan to Three Arrows Capital, Voyager also lists Alameda as owing them $377 million. That last tidbit came from Voyager's Chapter 11 filing. And the web is tangled further still, because Alameda was once the biggest stakeholder in Voyager. They had an 11.56% stake. That's a total investment of $110 million. Well, they surrendered 4.5 million shares to avoid reporting requirements. That leaves them with a 9.49% stake. In the meantime, Voyager's lawyers have received multiple bids to purchase the company that are higher than the deal that FTX offered. Joshua Sussberg is Voyager's attorney. Now, reportedly, he said in court that FTX's offer was the lowest of them all. He also said that those offers would allow customers to receive more than 30 cents on the dollar by way of comparison. In fact, Voyager has said that they've heard from 88 potential interested parties. 46 have signed NDAs. 22 are active in the sales process. Now, the final bid deadline comes up on August 26th. That's in preparation for this September 7th sale hearing. Now, Voyager is sounding confident. They said that they're planning on getting through the bankruptcy process in the first quarter next year. And just in time, the rally holds. People must have liked that 8.5% inflation call earlier today. because at the time of writing, the global crypto market cap is $1.14 trillion. It's up 4.42% in 24. The top 5 cryptos by market cap are Bitcoin up 3.89%, Ethereum up 9.16%, Tether, USDC, and Binance Coin up 1.08%. The Commodities Futures Trading Commission and the Securities Exchange Commission are proposing changes to reporting rules for large hedge funds. Now, these rules have to deal with crypto exposure, and it's no big surprise, really. Look at the problems crypto exposure has been causing some folks recently. However, these rules are only for the big boys, the really large hedge funds. Now, the agency has cited growth in the hedge fund industry as the reason for the change. This is also due to the rise of digital asset investments. And so what they're proposing is for the advisors to large hedge funds, they would have to report any exposure to digital assets. They put out a notice today. In this notice, they propose amending their confidential reporting form. This change would be effective for investment advisors to private funds of at least $500 million. So not me. Now, that doesn't mean that these hedge funds would include exposure to crypto when reporting cash and cash equivalents. Instead, they were added to a different category, quote, to report digital asset strategies accurately. The two regulatory agencies cited the growth of the industry as the primary reason for the change, and of course, the increasing use of digital asset investments becoming more common since the form was introduced in 2008. According to them, having investment advisors give more detailed information on strategies and exposure to certain assets would allow the Financial Stability Oversight Council to have a better insight into the U.S. economy. SEC Chair Gensler said, quote, in the decade since the SEC and CFTC jointly adopted Form PF, regulators have gained vital insight with respect to private funds. Since then, though, the private fund industry has grown in gross asset value by nearly 150% and evolved its terms of business practices, complexity. If adopted, this proposal would improve the quality of the information we receive from all Form PF filers, with a particular focus on large hedge fund advisors. Now, according to a fact sheet released today, the number of private hedge funds has increased by 55% in the period between 2008 through third quarter last year. According to IBIS World, there were 3,841 U.S.-based hedge funds as of this year. PwC reported this last June that 1/3 of traditional hedge funds were invested in crypto, which isn't quite the win it sounds like when you consider that more than half of them had less than 1% allocation to digital assets. Surprising no one, they list regulatory and tax uncertainty as the greatest barrier to investing in crypto. The global NFT market cap is down 16.67%. Sales volume is also down 2.69% in 24 hours. According to CoinMarketCap, the top 5 NFT collections by sales volume are CryptoPunks, followed by Mutant Apes, Moonbirds, Otherdeed, and CloneX. Now, keep in mind, some of these collections have very volatile prices, so do your own research. So, now, another exchange, Hotbit, they're saying that they froze customer funds. Now, it's not your typical reason, and some things aren't entirely clear yet, but one thing is crystal clear. They're not freezing funds due to market conditions and not freezing funds due to volatility. No, this one is a law enforcement matter against a former employee. So Hotbit put out a blog post today, and that post, they say, quote, suspended trading, deposit, withdrawals, and funding functions. And they're not giving a time frame for the resumption of those functions. By way of explanation, their post said, quote, a former Hotbit management employee who left in April this year, was, unbeknownst to Hotbit, involved in a project in 2021 that law enforcement authorities now think is suspected of violating criminal laws. As a result, a number of Hotbit senior managers have been subpoenaed by law enforcement since the end of July and are assisting with the investigation. Furthermore, law enforcement has frozen some of the funds of Hotbit, which has prevented Hotbit from running normally. Now, what happened is that they had an employee, a manager, and this manager worked for them until April. That employee was also working on another project. By the way, working on another project is against company rules. Well, that project is suspected of violating criminal laws. So it seems like those company rules are there for a good reason. Now, of course, Hotbit doesn't want you to worry. They're claiming none of the remaining employees have anything to do with this project, that they don't know anything about any illegal activities. Now, regarding the important matter of frozen assets, they said, quote, "The assets of all users are safe on Hotbit. Hotbit will resume normal service as soon as the assets are unfrozen. All user assets and data on Hotbit are secure and correct. However, we are still actively cooperating with law enforcement authorities in their investigations and are continuously communicating with them through our lawyers and applying for the release of funds." So there are consequences for these actions. As a result, all unfilled orders are canceled. All leveraged ETF positions will be liquidated. Now, that said, Hotbit is claiming that the income from users' investment products will still be distributed normally, that they have a compensation plan for users, and this plan is expected to be published when their website is resumed. Hotbit's announcement said, quote, "Hotbit is working hard to continue to cooperate and follow up on the progress of the investigation by law enforcement authorities and will announce the results of the investigation as soon as they are available." Hotbit is registered in Hong Kong and Estonia, with most of its staff from China, Taiwan, and the US. And we're going to call it there tonight. I want to thank you, my listeners, for tuning in, because if you stop listening, I will stop talking. Take care of yourselves, but take care of each other too. We'll see you tomorrow night.